Welcome to Global Gas Wrap. This month, we're tracking the high-stakes race that will redefine the market, the largest ever flood of new LNG capacity versus accelerating global gas demand. We dive into the stories that will tell us who might win. After falling just short of 10 million tons in October, U.S. LNG exports broke through the 10 million ton mark in November, setting a new monthly record for any exporting country, according to Capra Energy Group. The U.S. is now expected to set another historic milestone in the coming week by becoming the first country ever to exceed 100 million tons of LNG exports within a single year. It is also on track to finish the year with more than a 25% share of global exports, the first country to reach that level since Qatar nearly a decade ago. U.S. export growth is expected to continue through the end of the decade, with more than 60 million tons per annum of new liquefaction capacity reaching final investment decision so far this year, on top of projects already under construction. This unprecedented wave of development is set to anchor the U.S. as the world's leading LNG exporter well into the 2030s and beyond. Meanwhile, the International Energy Agency issued its World Energy Outlook and Gas 2025 reports, which outline a period of shifting market dynamics through the end of the decade. The IEA expects robust global gas demand growth to continue, with a net increase of 380 billion cubic meters by 2030 in its base case. This expansion is largely driven by industrial users and the power sector, particularly in Asia and the Middle East. Data centers and AI infrastructure are an increasingly important factor in the power demand outlook, especially where gas-fired generation is on the margin. In spite of this rapid demand growth, an unprecedented wave of approximately 300 BCM of new global liquefaction capacity will be commissioned by 2030, which translates to a net LNG supply increase of 250 BCM. This monumental supply surge is expected to outpace demand, creating a potential market surplus of 65 BCM by 2030. This projected oversupply may place downward pressure on global LNG prices, which, in turn, is expected to stimulate incremental gas demand from price-sensitive sectors and help rebalance the market. Now let's turn to the month's market activity. February JKM futures for LNG cargoes into Northeast Asia on ICE continued their downward trend, posting a fourth consecutive monthly decline. After falling nearly 3% on the month, JKM is now down more than 32% year-to-date. Open interest remains steady, while average daily volume rose to about 6,500 lots, with mid-month activity exceeding 15,000 contracts, equivalent to roughly 40 LNG cargoes. TTF natural gas futures weakened even further than JKM, falling below the $10 per MMBtu level for the first time since early 2024. The 8% monthly decline pushed year-to-date losses to 33%. The larger drop widened JKM's premium over TTF to 73 cents from just 24 cents at the start of the month. The loosening linkage between the two benchmarks was also reflected in falling correlation, which declined to 86% from 97% last month. ICE Henry Hub once again moved in the opposite direction, rising 7% on the month. Volatility at 38% remained significantly higher than JKM at 29% and TTF at 21%. With these gains, Henry Hub has now moved into positive territory for the year, up nearly 2% year-to-date. Thanks for joining us. Join us again next month for another edition of Global Gas Wrap.